Hello, I'm Jen Kohls of Richardson Capital Management, and I'm joined with Dan Brown, our Director of Investment Management. We're here to provide the economic and investment update for February 2024. In looking at the performance of equities and fixed income over the past month, it seems we have some good news and some not so good news to share. The good news is that stocks continue to rally, nearly all categories participated, and the S&P 500 advanced into record high territory. Dan, do you want to add some commentary to that?
Sure, Jen. So I just want to compare and contrast what we saw in the stock market between January and February. So in January, we saw really just the S&P 500 advance into record high territory with other categories lagging and producing negative returns. Quite a bit different though for the month of February. So we saw very broad participation really from all 11 economic sectors and then really all parts of the stock market. So whether it was large cap stocks, small caps, international, emerging market stocks, they all advanced. And if we had to, say why that is, I think investors are just getting comfortable with the economic trajectory for 2024, that this soft landing scenario is likely to play out. And investors are getting confident that earnings growth for the full year is going to play out and double-digit earnings growth expectations are hanging in there.
In contrast, fixed income was an area of weakness for the second consecutive month. This is because bond prices fall as interest rates rise. Dan, what is the latest news on interest rates?
So we saw interest rates rise for the second consecutive month to begin the year. And if we look at reasons why that is, we think that investor expectations around when the Fed will begin to cut interest rates has been pushed out. So to start the year, we saw that investor expectations were for the Fed to begin cutting interest rates in the March meeting. And now as we sit here in late February, those expectations have been pushed out further to June or July. And we think that's about right. We thought the timeline for the Fed to begin cutting rates in March was way too optimistic, just way too aggressive. Didn't think there was a reason for that. Inflation's trending the right direction and the economy is hanging in there. It's been very resilient and corporate earnings are strong. So again, we think that that's what's responsible for the backup in interest rates. But as we look out over the next year, we still think the outlook for traditional fixed income is very bright as corporate credit conditions hang in there just fine. And we would expect as we enter the second half of the year that interest rates should decline, which should lead to advances in bond prices.
Many investors are familiar with the Magnificent Seven, a group of large cap tech-related stocks. The Magnificent Seven was the main leadership group last year in earnings growth due to the enthusiasm surrounding artificial intelligence. Dan, we're seeing a change in this trend though, aren't we?
Yeah, a very positive trend. So the graph that we're showing here looks at earnings growth for both the Magnificent Seven stocks that you talked about and the remaining 493 stocks from the S&P 500. So to look back at 2023, we see the blue bars as represented by those Magnificent Seven stocks posted very, very strong earnings growth, while the remaining 493 stocks from the S&P 500 actually posted earnings declines. But as we enter 2024, we see expectations that the remaining 493 stocks should post fairly solid earnings growth, and those Magnificent Seven stocks are still going to post very solid earnings growth, but it's going to be less than last year. So that we would expect returns and participation to broaden out beyond just those Magnificent Seven stocks. And we're already seeing that this year. So for example, some laggards from last year are leadership groups so far this year. So for example, healthcare and technology sectors are actually leading the S&P 500, which we take that as an encouraging sign. And again, if we look at why that is, we look at the earnings growth. So for example, healthcare from an earnings growth perspective is supposed to post double-digit earnings.
With all that in mind, what is our outlook for the financial markets and the economy?
Yeah, the outlook for both is bright, Jen, and we're surprised how resilient both corporate earnings and the economy has been. So our outlook has definitely improved over the last 6 months. So because of this, we're going to make some changes in our discretionary managed portfolios. So all of our portfolios have owned a dedicated money market position. And we were fine with that because it's earning a very nice yield above 5% with no volatility. But we think the time is right to pare back some of that position and put that towards traditional fixed income where it's appropriate. So we talked about the outlook for traditional fixed income still being fairly bright as we expect interest rates to come down over the course of the year and credit conditions remain very strong. So we'll communicate that further in the next week or so.
Thank you for your insights, Dan, and thank you for watching. If you find value in watching our monthly videos, click like and subscribe below.